Hi, good evening, everyone. Welcome to UOB Hian CIO series number 29. Today, we're going to talk about what worked in 2025, what's possibly coming up next, and a sneak preview to 2026. Let me start with our year beginning predictions for 2025. I'm not sure you guys remember, we've been talking about this since December 2024 about our 5 bold predictions for this year. And we've been right on 4 out of the 5 so far. We correctly predicted the rebound in the Chinese economy and markets, that Chinese GDP did indeed beat expectations in the first half and third quarter, even though real estate continued to struggle. Number 2, on US-China relations, we said that things could temporarily improve, and that was indeed the case for the bulk of 2025. Until recently, US-China relations were relatively peaceful until the rare earth incident, and the market almost forgot about it at one point. So we also nailed that. We said that large cap US stocks may underperform in 2025 because of the high valuation and extreme outperformance in recent years. That unfortunately did not happen this year. As you know, Nvidia just crossed $5 trillion in market cap recently, and Magnificent Seven continue to outperform the rest of S&P 500. Number 4, we said there will be some extreme price volatility this year, and watch out for some systematic risk. Indeed, we have seen volatility spikes in crypto, in gold recently, and of course, equities has been a roller coaster ride this year. And most unexpectedly is the volatility in US dollar, which we shared with you since May 2025 about de-dollarization as a long-term trend. And lastly, on AI, we remain bullish, maintain a high conviction, and we've been saying that edge AI and AI applications will take center stage. It indeed grab all the attention and continue to proliferate in 2025, not just the data center, not just GPUs, not just the back end, but edge AI and AI applications. Just to remind you all, we have been consistently constructive on China, despite the volatility. And here's my CNBC interview from February this year, when the market was extremely pessimistic about tariffs and Trump being reelected and all these risks weighing down the China market. But we've been right, and we've been consistent. Now, let's take a quick review of my core views in third quarter of this year. For those who followed our research, you may have seen this in our Wealth Monthly, where we summarize our global views in one simple table. On equities, we've been saying that we remain cautious in the third quarter because of tariffs. I don't think the market has properly accounted for the tariff-related risks. Now, the outcome is a bit surprising that the markets continue to make record highs and pretty much fearless about what's happening in terms of tariffs and Trump's trade policy and geopolitical risks and all the things that happened this year. We're puzzled but we have to admit that we've been overly cautious. So that wasn't exactly a right call. On US equity, we were extra cautious, and turned out that we also been overly cautious. And S&P in third quarter alone was up nearly 8% and up double digits as of September 30th, 2025, which also surprised ourselves and maybe some people who were vigilant about tariffs. But having said that, we've been right all along on AI. Despite the ups and downs, we maintain a high conviction in AI. It's a topic that we always talk to you about. We actually have dedicated at least 3 or 4 CIO series just on AI across US and China. And in the US, we also like some of the defensive names, because regardless of what's happening around the world, stocks like Walmart and Berkshire Hathaway, I think they will continue to do well. On China, I just mentioned we have been absolutely right being a China bull this year. I'll save the details here. And the next thing on bonds, we do have a publication called a Fixed Income Monthly, where we share our fixed income views. And our views haven't changed for the last 2 years, which is we continue to view bonds as an essential asset class, and high quality median maturity bonds offer good value versus inflation expectations. What investors need to be aware of is the de-dollarization, which for some investors, it may take a hit on your fixed income investments because of that. De-dollarization, since we introduced the topic in May this year, it's become a hot topic indeed, and is very much alive. And you can see in the gold price making a record high just recently because of that. And that's also a commodity call. The only commodity call this year is on gold. We also been right on that. Related to our overall global view is our asset allocation, expressed in our all ETF portfolio. It's a model portfolio we've been running since December 2023. And like I said, we've been overly cautious on equities, and we've been underperforming with this portfolio because we underweight equities, especially US equities. But we are right on China. We overweight China. We were right on AI. In the US, there's the NASDAQ ETF. In China, we have the Hang Seng Tech ETF, both related to AI. And we've been right to overweight gold as much as 10% earlier this year. And we've been taking profits all the way through 4,000 an ounce. And despite underperformance, the portfolio has generated good absolute return of 13% annualized. Not a bad number, even though it has underperformed the benchmark. Before we talk about stock recommendations review, I want to share with you our barbell strategy. And this is also not new. We've been talking about this for at least 1 year. What is a barbell strategy? We think that the investor should split their portfolio into 2 parts. On one end, you have very safe investments, quote unquote safe investments, low risk, low return. We call it true defensives. On the other hand, you have AI innovative stocks that continue to generate high risk but high return, and to avoid stuff in the middle, which is supposedly medium return and medium risk, but really it's a high risk investment in today's environment because of all the extreme changes in the world. You might as well go for the risky AI plays, at least to give you high returns. So that's our barbell strategy in a nutshell. Extreme times call for extreme measures. That is our barbell strategy. Go to the extreme. what is tricky to define sometimes is the safe end of the barbell, what we call the true defensive. That's our proprietary way of looking at what is a defensive investment, not the usual way. And as you remember, we have a CIO series from September last year talk exactly that, how to play defense in an uncertain world. The message still applies today. Nothing changed. So our philosophy stands. Our framework works. And save you the details. You can look at the YouTube replay link. Basically, it's a return on investment capital-based framework. Help us to screen and analyze true defensive stocks. And when it comes to true defensive stocks, it's not just slow-moving or low return, like I said. Okay? It is stable, resilient, but the stock price could also go higher. One example, China Mobile is one of the top pick for true defensive. And since 2020, China Mobile is still one of the best performing stocks in a Hang Seng index. Not Alibaba. Alibaba is the best performing stock year to date among the big tech. But Alibaba is still down a quarter since 2020. Tencent is up only 28% since 2020. So you can see that these names can generate robust returns over time, including dividends. And Walmart is another case. Of course, Walmart cannot beat NVIDIA as a defensive name, but Walmart still beat Tesla since 2020. Don't forget defensives. These are a good place to be in this uncertain world. So with that framework in mind, defensives plus AI, let's talk about our stock picks, what we call the core recommendations. For the high growth end, we have AI in both the US and China, and it behaved as we expected, which is in a bull market, these names do well, and China particularly has been catching up with the US for both fundamentals and valuation reasons. I'm not sure if you still remember, earlier this year, we have a seminal event of the launch of DeepSeek in China, which changed the world's view about where China is in terms of AI development. Also changed our view about Chinese AI potential. And we've been bullish, super bullish on China AI since then. So all of our stock picks work well, very impressive returns, but also come with high risk. But in a bull market, that's what it works. Defensive, I mentioned earlier, it could do well, but it's unlikely to beat the market in a bull market like this. But you can see that most of these names have generated attractive returns this year. And what is not shown here is their performance during down markets, during the correction this year, and almost all of these stocks has outperformed the market when Trump announced reciprocal tariffs in early April and when the market panicked, and these names offer you a good downside protection. Related to these stock picks, we have the US stock model portfolio constructed based on the AI recommendations we just mentioned, the defensive recommendations, and our trading buy recommendations. It's up 12% year to date, mainly because our underweight in US equities. We still maintain about 30% cash. That's why we lagged S&P. But like I said, if you look at single stock picks, whether it's Broadcom, or NVIDIA, they both outperform S&P 500. And since we launched this, we're up 52%, definitely outperforming S&P 500. On China, we were right on the fundamentals. We were a bit too conservative with the stop picks. But again, 22% return year to date, cannot complain. We can always make more, but 22% this year, just 10 months of the year, 9 months of the year, 9 to 10 months of the year, and almost 40% in 2 years. It's not a bad return. And we still maintain about 17% cash in China stock model portfolio. For all three portfolios, let me recap. The all ETF portfolio for asset allocation, for your global views, the US stock model portfolio, and our China stock model portfolio. All three portfolios, if you like to receive our daily update, please contact your sales representative or private wealth management research at UOB Hian. Okay, as promised, let's look at 2026 now. It's not too early. We only got about 2 months left of the year. And before I share my outlook, I want to talk to you about two things. One is, I'm sure someone's going to ask, what is your year-end 2026 price target for Hang Seng Index, for example? And as you know, I tend to avoid those questions. I almost never give price targets, even if for gold, which I have very long-term conviction in. And the reason is this: today's markets work very differently now. They're constantly and rapidly changing. And within the markets, there are also a lot of structural changes that is not necessarily captured by the market index. And there's another practical issue. I just give you one example here. If you look at a Hang Seng Index in the chart below, let's say you correctly predicted against all odds at the beginning of this year that Hang Seng is going to reach 26,000 at the end of 2025, at early 2020. When you make that prediction earlier this year, what will happen? First of all, you're right, but the market almost reached 26,000, remember, in somewhere around March 2025. Then what you do? 3 months of the year, your target is almost reached. You sell or you lift the target to 28,000. Most people will trade a momentum when it reaches 26,000, they think it's going to go to 28,000. So again, most people will probably be bullish at that time, but the market crashed. And when the market crashed almost to below 20,000, would you still have conviction in your 26,000 price target? Is that still a meaningful price target? It's easier said, yes, but in reality, it's not easy. Okay? People forgot how panicked the market was when NVIDIA was even trading below the $100 a share. Now it's almost $200. So not easy. And then now let's look at now. Now it's over 26. It breached 26,000 at one point, right? Now what? What do we do? What next? It's not like the index of 26,000, we wash our hands and we can go home and sell all stocks and job done. The investment is a constant game. It's a perpetual game. You still have to look forward to the next thing, the next year. So I don't think the fixed point target is that helpful. It's good to know sometimes, but it doesn't really help our investment decision. What we need to have is a directional bias. If you can have a directional view, at least a directional bias. And then the other thing I want to talk about is, what if we are wrong? We've been wrong. I already showed you we've been wrong 1 out of our 5 predictions this year. We've been wrong on US equity being too conservative. We're wrong on global equity. What do we do when you're wrong? That's called risk management. And that is more important than taking views, because every view we take, we already assume that we could be wrong, and we're going to do something to make sure that we're prepared for those situations where we are wrong. So here's a simple math can show you that you could be wrong more than 50% of the time and still make money, because you could manage your risk properly. If you minimize your loss when you're wrong and try to maximize your wins when you're right, you can still make money even if you could be 60% wrong. Right? So that is the math. And also, it's easier said than done, but that is the truth. So risk management is very important. So with those two things in mind, no fixed price target for 2026. Number two is, let's prepare that we are wrong. Let's talk about the 3 disruptive forces for the next year and even the next decade. And you've seen this before, because we've been talking about this all through 2025. Nothing changed. Not much has changed. I don't think not much will change in 2026. The 3 most important factors: US-China relations, de-dollarization, and AI. And the reason to put this circular arrow in the center is to show you these 3 things are actually interrelated. Now let's take those 3 things and give an outlook for 2026. For US-China relations, I expect things to get worse, not better. I expect to have some thunderstorms or even some super typhoons in US-China relations in 2026, because of the midterm elections coming up, because of US and China continue to engage each other in these strategic competition, or in some cases, trade war or tariff wars. That's not going to change. That's not going to end, even though we have the news today that there may be some truce, but we all been there before. They said we have truce, then suddenly one side decided to impose new restrictions. Exactly what happened a month ago. Long term, also do not expect to things get better. This is a divorce between the US and China. It's not a simple couples fighting. What do? If we cannot take a view on which side will win, why don't we bet on both horses? Because US and China are uniquely different, inherently different. They offer different opportunity sets, and why don't we just invest in both? So you need to invest in both US and China, because the outcome of this competition is unclear, and they also offer very different opportunities, which I'll talk in a second. De-dollarization is not going to change, and it will continue for next year and for the next 10 years. It's a long-term secular trend. On AI, we are seeing some cloud gathering in the near term. This is not the stock price speaking. If you look at the stock market, the market is telling you all things are fine, but not all things are fine. Long term, we're still bullish. We still have high conviction. Just next year, prepare some small headwinds, possibly some hiccups. US-China relations. Let's dig a bit deeper. What does Trump really want from China? That is the key question. That answers why we don't think there's an easy solution. The reason US-China relations will continue to face an uphill battle is what Trump wants is China could not give or cannot give. What Trump wants is the China to open up, not simply buying more US products. In the past, we have a number of US companies that were very successful in the US and elsewhere, but they failed miserably in China. So in some cases, it's their own fault, not fully understand the Chinese market. In other cases, there may be some artificial barriers that are still in place to prevent from these companies becoming successful in China. I think are those barriers that Trump wants to break down and he has said this numerous times, I think trade is just an excuse. All the sanctions are just a bargaining chip to beat China to open up. I think that that's where the two may have some very deep differences of what could be opening up. De-dollarization, we talk about this at least 3-4 times. I'll be really brief here. Basically, it's about the long-term declining dominance of the US dollar in global trade, investment, and reserve systems. 4 drivers of de-dollarization. These 4 drivers, if you dig a little bit deeper, nothing's changing next year. In fact, some of them may get worse next year. The Fed last night just said that they're not sure about December cuts. So what about 2026? I think the Fed will face even more of a conundrum or uncertainty with the monetary policy. When you have uncertainty in the monetary policy, you have uncertainty in the currency, in this case, is the US dollar. So de-dollarization, very much alive, and be prepared. Just that in the short term, we're not seeing much change in the US dollar index. All right? If you watch the US dollar index, in the last couple of months, it's been stabilizing. Why? Because this US debt challenges, the fiscal imbalances are not just the US. Europe is facing similar issues, and Japan's the worse problem than the US. So that help explain why the US dollar index was stabilizing, but gold still broke 4,000. Why? People were not just preparing for some US debt problem across Europe, UK, Japan, developed world seem to have a common set of debt challenges. And people want to move away from those government securities as much as possible and use gold either as a hedge or as a safe haven. De-dollarization, we've been saying this before, that it's very important to build a currency diversified fixed income portfolio. It's not just the US dollar fixed income. And because we're a Singapore company, we have the advantage of offer some Singapore dollar products, Singapore dollar bonds, and Sing dollar, for its worth, is viewed as a safe haven currency today. And the de-dollarization will only reinforce Sing dollar's status. On equities, not to worry too much about US equities because they are global companies, and if managed properly, like we are helping you to do so, you could still generate decent returns over time to offset the US dollar weakness. So US equity, kind of like Japan equity in the future, Japanese equity record high, but Japanese currency record low. Net, because equities still give you high enough returns to offset the currency weakness. China equity, especially RMB exposure, is a good hedge against de-dollarization, and we are already seeing some global money moving in that direction. Okay, and Hong Kong dollar, even though Hong Kong equity is a Hong Kong dollar asset, but in reality for H shares, because their businesses are based in China, their revenue, income, and dividends are generated from China in RMB. Hong Kong shares, H shares, are actually an indirect RMB asset. Okay, so that's not strictly a US dollar asset. That's perhaps another reason that Hong Kong stock market has outperformed this year, is partly because people wanted to diversify away from S&P 500. And on commodities, we continue to like gold, and this year we missed on the gold miners, which is something that we need to look into further. On AI, you've seen this before. We have a very different approach on AI. That's one of the 3 forces I mentioned earlier. Now, what I mean by the cloud gathering in AI is really this chart, which shows you that AI CapEx has doubled, more than doubled in the last 2 years, growing an average 55% a year. That's no longer the case in 2026. So please don't mistake me as say AI will grow negative. It's just that the growth rate will decelerate from 55% to 18-20%. The lowest number I saw was 11%. Depending on the source of these estimates, definitely not going to be another 50% growth in AI CapEx again. So what does that mean? That means a lot of different things. First of all, I'm not sure you see this from our Wealth Monthly just published this month. The US economy is predominantly driven by AI CapEx. If AI CapEx slows, the US economy will show its true face, which is some soft belly in the US economy will begin to show. There may not be a recession, but the growth may very well slow down. So that's the macro risk. And AI CapEx will cause a slowdown in slowing AI CapEx will cause slowdown in data centers, in GPUs, NVIDIAs, in semiconductors, in DRAMs, in memories, all these semiconductor stocks. So let's see if I'm right when NVIDIA report earnings later this year. Of course, the market is telling you the stocks are record high, nothing to look at, nothing to worry about. But remember this chart. The numbers speak for itself. The growth is inevitably slow down. It doesn't mean it's going to go negative. It doesn't mean we're going to change our long-term conviction AI. It's just a usual normal slowdown versus extremely high expectations. So what do? I said earlier that we may have some cloud gathering AI in 2026. And since a year ago, since second half of 2024, we've been saying to move your eyes away from NVIDIA, not just invest in NVIDIA. Of course, this year NVIDIA still did very well, but let's focus on applications. The data center spending may slow, GPU sales may slow, it will still grow, but it's not going to be as impressive, may not be as impressive as before, but the AI applications will continue to proliferate, to develop. Two things. One is something called edge AI, which is the layman terms, AI devices. Tesla cars is the AI device. It has driverless technology. That's an AI-enabled technology. Meta smart glasses are AI devices now. And Apple's iPhone, even though it's lagging in AI, will become an AI device in the near future. And the other thing is on the software side, something called AI agent. We've shared this also in our previous webinars. What this does is really AI programs that can not only answer your questions, but also can do things for you. That's what we really need. It's not just Q&A. We need people to actually execute things for us. So all these things are happening. And let me just wrap up about what to do when you have AI may face some short-term or long-term risks. Even long-term, we like AI, it's not without risk. I talk about focus on AI applications. That's the end game. But also to move your eyes outside the AI space. I talked about the defensive earlier. So your portfolio cannot be just about AI. I talked about Walmart, I talked about China Mobile, Berkshire Hathaway. All these things are in our portfolio, on our core recommendations. And I would say they serve a purpose to balance your portfolio, but also serve a purpose of hedge the AI risk in case AI have problems. These companies will continue to do well. You want to have those companies in your portfolio. Okay. Positioning for 2026. I talk about the three forces that are going to drive the market in 2026: the U.S.-China relations, AI, and de-dollarization. How shall we position 2026? This is a very preliminary conclusion. In the U.S., we will stay invested in AI and the defensives. I just talk about the defensive as an important hedge against AI, or even just a hedge overall for geopolitical risks or for all kinds of unforeseen risks. We also like energy, continue to like energy as a hedge against geopolitical risks, and also beneficiaries of the increasing demand from data centers and AI. Energy is a great play for those type of applications. In China, you also need to have both, right? So AI plus defensive, that's always a good combination. That's our barbell strategy. Let me say this another time. The barbell strategy dictate both our US and China investment strategy. For China, we also like something called the tourism, Macau gaming stocks, and Trip.com. And Trip.com is interesting because it's actually both a tourism play and an AI play. I can talk more about that if you're interested. Potential new themes in 2026. And this is also what we missed in 2025. I said earlier that we cannot be right on everything. We cannot make all the money off the table. We've been right on certain things. We'll make decent money this year in our model portfolio, but we also missed a great number of things. One of the things we missed is nuclear energy and related materials. That's something we will go deeper into 2026 as soon as possible. So please follow us. Please ask us questions in the future when we launch our report or core recommendations there. I think there's some really interesting names and ETFs we can look at. Aerospace and defense. That's a geopolitical risk trade, maybe related to Donald Trump, maybe just related to overall shifts about how things are changing globally between countries. But there's also one caveat here, which is the success of Chinese EV makers are now driving European car makers to this business. That is one business, the defense industry, that could not possibly outsource to China, could not possibly import everything from China. So that's a national security matter. That's an economic matter because European and Japanese companies need this business to counter the loss from competing with Chinese industrial companies. So that is a booming industry for several reasons. Europe will continue to invest in these areas and continue to subsidize. Gold mining, I mentioned earlier, is something we missed this year. And I think it's interesting because it has attributes of both gold as a commodity and as equity. I mentioned earlier that we've been overly cautious on equity, so we missed the equity rally. So perhaps if we are wrong again on equities being too cautious, we can use gold mining equity stocks as a way to catch up at both angles. And lastly, on the new China consumption, it's a very interesting story now that overall consumption in China is not changing much. In fact, the latest numbers, the China's consumption has entered the lowest month in September. 3% growth only, the slowest month year to date and the slowest month in almost 12 months. Okay, but if you look underneath the 3% growth, there are a lot of interesting secular structural changes within Chinese consumption, like online, like gold jewelry, like things have emotional value, attachment to it. Not necessarily practical things, but things like toys and or tourism. That's another consumption theme that we've been sharing with you and making core recommendation about that fits under the new China consumption. And if you look at Chinese GDP today, it is still predominantly driven by domestic consumption. So that's a very important matter. We'll continue to find new ideas and new themes for you in the near future. And before we go into Q&A, just to remind you how important this US-China relations are in understanding the markets and finding opportunities and protecting yourselves in terms of your investments. So for that, we are hosting our inaugural UOB Kay Hian CIO series. This is a live event, physical event, not an online webinar, focused on US and China. We will be inviting some of our fund management partners, some of you have met or spoken to before, like Aqua Lake and Slam, highly qualified, and some of them experts on investments or US, China, or AI, to talk exactly about the dynamics between the world's two superpowers. November 19th, from 10:30 on at the Island Shangri-La. For private wealth management clients, please RSVP to sign up. With that, I'd like to turn to Q&A and see anyone have any questions. Thank you. If you have any questions, please use the Q&A window to enter your questions manually, and I will answer them as much as I can. Any questions, please enter them in the Q&A window. We will answer them in order they're coming. Okay, I don't see any questions. Maybe I was being so eloquent, that so clear that no one has any questions. Fine. The replay of this webinar will be uploaded on our Wealth Vision channel on YouTube as usual. And today's presentation will be shared to anyone who's interested, and please contact your UOB Kay Hian sales representative. Thanks again, everyone, for participating, and I look forward to talking to you for the next CIO series.